Today we will investigate why Bernard Arnault is buying more LVMH stocks at the moment, how LVMH managed to sell luxury at volume, and whether the stock's latest drops might be the perfect anti-cyclic buying opportunity for defensive long-term investors. Bernard Arnault's early career began in 1971, not in high fashion and haute couture. Instead, he started working at his father's engineering company called Ferret Savinel. When Arnault started, he convinced his father to shift from engineering to real estate, which was the foundation for LVMH as we know today. Just a few years later, in 1984, Arnault heard that Ferres, the owner of Dior, was being offered for takeover by the French government. To win the bidding war, he outsmarted competitors by acquiring Financier Agache, a luxury goods company which gave Arnault more buying power and influence. Fast forward to 2020, and Arnault's empire of brands such as Dior, Fendi, Louis Vuitton should be extended with another gem. The following trade would not only increase sales but also push LVMH's branding to new levels. LVMH acquired the jewelry company Tiffany & Co. for $16 billion and completed the takeover in 2021. While LVMH closed one of the largest takeovers in history, the stock's price to earnings ratio soared to staggering levels of 66. This implies an investor pays $66 for just $1 of LVMH earnings, which is highly overvalued for long-term and defensive investors like Warren Buffett. Buffett himself bought even high-growth stocks such as Apple at PE ratios of 13 or lower in 2016. This amplifies the importance of rational and defensive pre-analysis of the valuation and the earnings of the stock before buying. Speaking of earnings, LVMH has an incredible push in recent years. Starting in 2019, the earnings per share were $15.99, dropped during the pandemic crisis to $11.39, and reached new records in 2021 with a jaw-dropping EPS of $27.17. This trend was fostered with $30.06 in 2022 and $33.45 in 2023. At the same time, inflation spiked in the US to historic levels of 8% and 4.1% respectively, amplifying the psychological feeling LVMH embraces of uniqueness and exclusivity when buying pricey handbags. Suddenly, bad news came in for LVMH, and the EPS in 2024 declined for the first time in 4 years to $25.13. So what changed in 2024? The consumer sentiment, especially in Asia, cooled dramatically. For instance, LVMH's 2021 revenue from Asia was 35% and dropped to 28% in 2024. This resulted in a revenue decline for Asia from $25.5 billion in 2021 to $24.2 billion in 2024 due to the decline of the dollar-euro ratio. All in all, we see that the top region for revenue growth is faltering for LVMH. Meanwhile, all the other regions are growing but can't fill the gap for Asia. This becomes most apparent since Asia has 39% share of the fashion and leather goods segment, which is by far the most important for LVMH, as it contributes 49% to LVMH total revenue in 2024. As defensive long-term investors, we should always use long-term metrics such as the 3-year average PE ratio. Therefore, we use the average of the last 3 years' earnings per share, which was $29.55, resulting in a 3-year PE ratio of 20. Compared to LVMH 1-year PE ratio of around 24, we clearly see the effect of last year's earnings drop. The first 6 months of this year, LVMH revenue is still shrinking compared to the first 6 months of 2024, from around 42 billion euros to around 40 billion euros. Of course, the weak dollar compensates LVMH revenue decline, as in US dollars, the revenue was $44.7 billion by the end of June in 2024 and $46.9 billion by the end of June this year. Meanwhile, a first good sign might be that Arnault starts in 2025 to buy more LVMH stocks, but the golden question remains, will LVMH recover? And which signs do we see to expect an earnings growth comeback in 2026? Most US consumers are currently replacing LVMH brands with semi-luxury brands like Ralph Lauren or Coach. Key reasons are the younger demographic of those brands. As this Wall Street Journal article analyzes, Coach and Ralph Lauren are growing in a difficult market partly by targeting young consumers. Coach said it added 1 million new customers in North America last quarter, most of whom were Gen Z or millennial. European brands might have unwittingly helped their US rivals by raising prices too quickly in recent years, leaving young and middle-class shoppers with few budget-friendly choices. Currently, LVMH cannot compete with trendy and cheaper US brands within the most important segment, fashion and leather goods, which indicates severe issues. So what are the good signs to argue in favor of LVMH stock? One brand seemed to outshine others, and that is Sephora, the prestige beauty retail store offering a curated assortment of over 500 beauty brands while growing double-digit. Unfortunately, LVMH does not disclose the growth rates of Sephora. Instead, its group called selective retail can be analyzed, which is the fastest growing segment of LVMH. For instance, the fashion and leather goods segment generated 12.842 billion euros in profit for 2021, while in 2024, the same segment delivered 15.230 billion euros, resulting in an increase of 18.6%. Perfumes and cosmetics dropped by 2%, watches and jewelry dropped by 8%, and wine and spirits dropped by a staggering 27%. Meanwhile, selective retailing outperformed all other segments by growing 160% in profit. So, Sephora and the beauty segment should not be underestimated for the growth potential of LVMH in the near future. Additionally, LVMH's strength is mergers and acquisitions, and as all luxury stocks are struggling at the moment, it might be the perfect time for a new takeover. Peers like Kering's Gucci are in a severe crisis, which might open the door for an opportunity to expand LVMH brand portfolio. At the same time, Armani also seems to be on sale as the founder opened the door in his last act. Both brands could spur LVMH's fashion segment and push it to new records. An important part of LVMH's history is the saga with Hermes, as Arnault sought to acquire the company, beginning his purchase of shares in 2010. After the family behind Hermes began to switch to a family-created holding to prevent further outside acquisitions, LVMH soon sold almost all of its stake. Why does this matter? Well, Hermes is probably the strongest competitor to LVMH. Investors in the luxury segment often can't decide which stock to choose or simply buy both. Hermes' company strategy and structure differ fundamentally from LVMH, as Hermes is not a consortium of multiple brands. Instead, it's a single brand focused on the main brand Hermes. Hermes also has some sub-brands such as the bootmaker John Lobb, silversmith Puy Foucault, and crystalware from Saint Louis, which are less known and not the main focus of Hermes. When analyzing the last 3-year PE ratio of Hermes, we clearly see the exclusivity not only from Hermes bags, as its stock increased earnings of the last 3 years with $34.36 in 2022, $45.40 in 2023, and $45.45 in 2024. Now, here comes the catch. This results in a 3-year PE ratio of staggering 58. Which is quite expensive, especially compared to LVMH's 3-year PE ratio of 20. Without doubt, LVMH is in the middle of a crisis and has to adapt to younger and more price-sensitive consumers who ditch Louis Vuitton not for an Hermes bag, but instead for a Coach bag, and who won't buy a $1,400 sweater from Dior and instead buy a $140 Ralph Lauren one. As always on Wall Street, it comes down to what you pay for what you get. With a 3-year PE ratio of 20, LVMH is reasonably priced and can be considered a buy for defensive long-term investors. Profit growth can be expanded with brands like Sephora and long-lasting iconic brands, which hopefully see more glamorous times, like in 2021 again, especially if LVMH can acquire an old gem like Armani or Gucci from Kering. Thanks for watching and see you in the next one.